Imagine trying to put out like a roaring house fire with a standard issue garden hose. You know, you're just standing there in the front yard spraying water as fast as you can.
Right, just hoping the flames die down.
Exactly. But every time you turn your back, someone is standing on the roof pouring buckets of premium gasoline straight down the chimney.
Oh, that's a brilliant way to put it.
You're just exhausted. I mean, the hose isn't cutting it, and you start to wonder if your water is doing anything at all. And that scenario, that feeling of utter futility, that is exactly what the Federal Reserve is dealing with this week.
It really is. It's a phenomenal contradiction. I mean, we are watching a central bank try to cool down an economy that is simultaneously being set on fire by global events.
Yeah, and that's why we're here today. Welcome to a Bulls, Bears, and Bells special deep dive. Today is Friday, July 24th, 2026.
And honestly, if you have any money in the stock market right now or, money in a savings account, or even if you're just thinking about applying for a loan, you need to pay attention.
Oh, absolutely. The entire financial world is basically holding its breath. So our mission for today's deep dive is highly specific. We are preparing you for the massively anticipated Federal Open Market Committee, the FOMC, their interest rate decision coming up next week.
Yeah, July 28th and 29th.
Yeah.
And the stakes for this particular meeting just, they cannot be overstated.
No, they can't. We're currently sitting with the federal funds rate target anchored between 3.50% and 3.75%. That is the baseline cost of capital.
Right. But that rate is currently being tested by what is essentially a perfect storm. I mean, we've got violent geopolitical energy shocks.
Which are just relentless right now.
Exactly. Plus a domestic labor market that is throwing up flashing red warning signs.
Yeah.
And of course, a brand new Federal Reserve chair who is systematically dismantling the way central banks have operated for the last 15 years.
Okay, let's unpack this because we have a lot of ground to cover. We're going to look at the massive cross currents in the 2026 global economy and specifically how this Middle East conflict is bleeding into your everyday expenses.
Which it absolutely is.
From there, we're going to look at Kevin Warsh, the new sheriff at the Fed, and why he is refusing to play the usual Wall Street games.
That's going to be a fun one to talk about.
Oh, definitely. Then we'll map out the 3 actual scenarios for next week. A rate hold, a hike, or a cut, and reveal exactly how each of those moves will mechanically impact your equities, your bonds, your crypto, and even your local bank.
Because, look, in an environment where the data is this noisy, our goal is to isolate the signal.
Right. We have to separate the signal from the noise.
Exactly. We need to connect the dots between the raw numbers flashing on terminal screens, the geopolitical realities on the ground, and the structural integrity of your portfolio. Understanding the why behind the market moves is the only way to avoid being blindsided.
I want to start by zooming out, actually, because before we can even try to predict what the Fed is going to do next Wednesday, we have to understand the nightmare they are navigating.
And that nightmare starts thousands of miles away from Washington, D.C.
Yeah, we are dealing with the fallout of the 2026 Iran war, Operation Epic Fury, which kicked off in February.
Right. And to really understand the economic impact, you have to look past the military headlines. You need to focus purely on the logistical choke points.
Because that's where the economic damage actually happens.
Exactly. The immediate closure of the Strait of Hormuz back in February. And you layer that on top of the continuous Houthi threats in the Bab el-Mandeb Strait.
It's just a mess.
It effectively severed a massive artery of the global energy supply chain. Suddenly, tankers carrying Saudi and regional oil had to either halt completely or reroute thousands of miles.
And that costs time, it costs insane insurance premiums, and obviously a ton of fuel.
Yeah, and the market reaction was incredibly violent. We saw Brent crude absolutely skyrocket, hitting a peak of $126 a barrel in April.
Which was just painful at the pump. Now, we did get a breather for a minute there. There was that Pakistan-mediated ceasefire in the spring and oil cooled off, but July 8th changed everything.
It did. The collapse of that ceasefire on July 8th, that was really the catalyst for the panic we're seeing in the markets this week.
Commercial shipping was attacked again.
Right, and the president declared the ceasefire officially over, the military strikes resumed, and just like that, Brent crude is surging back above $95 a barrel as we speak.
Okay, I want to stop right there for a second because I see this headline all the time. It's always like, oil spikes, Fed panics.
Oh yeah, constantly.
Right. I understand that $95 oil is bad for my wallet when I go to the gas station, but mechanically, why does a spike in oil paralyze the Federal Reserve? I mean, why can't they just look past it and say, well, we don't control the Middle East, so we'll just ignore the oil price?
What's fascinating here is the dual contradictory nature of an oil shock. It is the single most frustrating event for a central banker
Why is that?
because it creates two entirely opposing economic realities at the exact same time. On one hand, oil is the foundational input cost for the entire modern economy.
Right. It's not just the gas in your car. It's the diesel in the trucks delivering your groceries. It's aviation fuel.
Yeah, and it's the petroleum used in manufacturing plastics, fertilizers, literally everything.
Oh.
When the price of oil spikes, the cost to produce and transport almost every physical good increases.
And businesses aren't just going to eat that cost. They pass it on to consumers.
Exactly. So headline inflation, which is the raw number tracking the cost of living, that spikes. S&P Global is actually projecting this renewed July oil shock will push near-term headline inflation up to 4%.
Wow. 4%.
Yeah, and normally when inflation hits 4%, the Fed's mechanical response is to raise interest rates to cool off demand.
But you said there were two opposing realities, so what's the other side of the coin?
The other side is that high energy prices act as a massive regressive tax on the consumer.
Ah, okay.
Right, if you suddenly have to spend an extra $150 a month just to commute to work and heat your home, that is $150 you are no longer spending on dining out.
Or buying new clothes, or upgrading your software subscriptions.
Exactly. So discretionary spending drops. The consumer gets squeezed, and when discretionary spending drops, corporate revenues fall, businesses pull back, and the economy slows down.
Man, what a nightmare. So the Fed is staring at a dashboard where the inflation gauge is flashing red, demanding higher interest rates.
Yes.
But the economic growth gauge is also flashing red, warning of a slowdown and demanding lower interest rates.
Precisely. They are trapped in a classic stagflation dynamic. Stagnant growth combined with high inflation.
That brings up a crucial distinction in the data, actually. You mentioned headline inflation hitting 4%, but S&P Global also projects that core inflation is only going to sit around 3%.
Yes, that's right.
Can you explain the mechanics of core versus headline? Because if I'm a normal consumer, I don't get to strip out food and energy from my actual monthly bills, so why does the Fed care about core?
That is a brilliant point,
Oh.
and honestly, it's a source of massive frustration for the average person.
Yeah, because my grocery bill is very real to me.
Of course it is. Core inflation strips out food and energy, precisely because those categories are highly volatile. They're often driven by geopolitical events like a war or a drought that the Fed's interest rates cannot fix.
Okay, so raising rates doesn't produce more oil.
Exactly. The Fed focuses on core inflation because it shows the underlying sticky inflation in things like housing, medical care, and services. If core inflation is at 3%, the Fed assumes that the extra 1% from the oil shock is temporary.
There's a breaking point there, isn't there?
Oh, absolutely. The longer oil stays at $95 or higher, the more it bleeds into the core.
Right, because if diesel stays expensive for 6 months, a plumber has to raise his hourly rate to cover his truck's fuel.
And that drives up service inflation. That transition right there, that is what keeps Kevin Warsh awake at night.
And this stagflation trap perfectly sets up the massive contradiction we're seeing in the domestic economy. Because while energy prices are just boiling over and threatening to drag consumer spending down, the domestic labor market is suddenly sending off alarm bells.
Yeah, warning signs that the slowdown is already here.
We got the June jobs report a few weeks ago, and it was an absolute shocker.
It was a stunning miss. I mean, the U.S. economy added just 57,000 jobs.
Which, just to give you some context on how bad that is, the consensus expectation from Wall Street economists was 115,000 jobs.
Yeah, it missed by half.
And it wasn't just a weird one-month blip either, was it?
No, the downward revisions were perhaps the most concerning part of the entire report. The Bureau of Labor Statistics revised the previous 2 months downward by a combined 74,000 jobs.
Oh, wow. That is significant.
It is. The trend line is definitively cracking. While the headline unemployment rate is holding at 4.2%, underneath the surface, it's ugly. The participation rate is falling, and job gains are becoming hyper-concentrated in non-cyclical sectors.
Like government and healthcare, right?
Exactly. Private sector hiring is basically freezing up.
But wait, let me push back on this a little bit. Because if you only look at the 57,000 jobs, you'd think the sky is falling. But when I look at the broader macroeconomic data, this economy just refuses to die. I mean, it feels like driving a car where the parking brake is pulled all the way up, which is the Fed's restrictive interest rates trying to stop the car.
Right.
But someone else has dropped a cinder block on the gas pedal, and that cinder block is the artificial intelligence boom.
If we connect this to the bigger picture, You are hitting on the exact structural counterbalance that is keeping us out of a deep recession right now.
Yeah.
The sheer volume of capital expenditure, or CapEx, pouring into AI infrastructure is staggering. We are talking about hundreds of billions of dollars being deployed to build data centers, lay fiber optics, and manufacture advanced semiconductors.
I was actually reading the latest IMF report on this, and despite the war in the Middle East, despite the oil shock, the IMF just revised world GDP growth up to 3% for 2026.
Which is incredible given the macro environment.
Right. And their explicit reasoning is that AI-driven demand and the productivity gains associated with it are creating this massive tailwind. It's so powerful, it's offsetting the negative drag of the oil shock.
Yeah, even the Wall Street Journal just put out a survey of, I think, 74 top economists, and the probability of a U.S. recession over the next 12 months actually fell.
Wait, it fell?
Yeah, it fell from 43% down to 25%.
It's a remarkable divergence. You have a macro environment defined by J.P. Morgan estimating a very steady, albeit modest, U.S. GDP growth of 1.5% to 2.0% for 2026.
So the Fed is sitting in their boardroom looking at a labor market that is adding a meager 57,000 jobs.
Right.
Alongside corporate GDP growth fueled by massive technological investment, all while a geopolitical oil shock threatens to spike inflation back to 4%.
So the impossible choice for the FOMC next week is, do we fight the $95 oil-driven inflation by raising rates, knowing that the labor market is already on thin ice and we might just shatter it completely?
Exactly.
Or do we try to rescue this freezing job market by cutting rates and risk pouring gasoline on the inflation fire?
Precisely. And this impossible choice brings us directly to the institutional upheaval at the Federal Reserve itself.
Yes, let's talk about that.
Because the economic data is a tangled mess, sure. But the way the new leadership is choosing to handle that mess is sending shockwaves through the entire financial system.
We have to talk about Kevin Warsh. On May 22, 2026, he took the oath of office as the 17th chair of the Federal Reserve. He replaced Jerome Powell,
who actually remains on the Board of Governors for continuity, which is an interesting dynamic on its own.
Yeah, it really is. But Warsh stepping into the big chair has been an immediate, jarring shock to the system, hasn't it?
Oh, it has been a total paradigm shift. Warsh's philosophy is a stark departure from the last decade and a half of central banking.
Yeah.
From his very first press conference, his singular refrain has been brutally simple. Prices are too high.
Very blunt.
Very. He is projecting a hypervigilance on inflation that we haven't seen since the Paul Volcker era of the early 1980s. But it isn't just his hawkish stance on rates that's causing the upheaval.
No, it's his communication style, right?
Exactly. It's his fundamental philosophical rejection of how the Fed communicates with the public.
Yes, the death of forward guidance. I want to spend some time here because forward guidance has been the absolute bread and butter of the stock market since the 2008 financial crisis.
It really has.
Explain the mechanics of what forward guidance actually is and why Warsh hates it so much.
Well, forward guidance is essentially a central bank's way of managing market expectations by making promises about the future. For example, during the pandemic, the Fed didn't just cut rates to zero.
Right. They explicitly told the market, we expect to keep rates near zero until at least 2024.
Exactly. And they do that so a business feels perfectly safe taking out a 5-year loan, knowing their interest rate won't suddenly spike next year. It provides certainty. It attempts to control long-term interest rates by anchoring expectations.
But Kevin Warsh doesn't buy into that.
No. Kevin Warsh argues that this is an incredibly dangerous and arrogant way to run a central bank. His view is that the economy is fundamentally unpredictable. I mean, as evidenced by the sudden outbreak of war in the Middle East.
Which nobody can model for.
Right. If a central bank makes a promise in January based on January's data, but the world fundamentally changes in March, the central bank is now trapped. If they break their promise, they lose credibility. If they keep their promise, they enact the wrong policy for the new reality.
I love the poker analogy for him. It is like he's sitting at the final table of the World Series of Poker and he flat out refuses to give the market a single tell.
That's a great comparison.
He's looking at Wall Street and saying, I am not going to hold your hand anymore. I will react to the data as it comes in, and I reserve the right to hike or cut at a moment's notice.
That is exactly his stance. He wants maximum flexibility.
Yeah.
And we saw this play out in a highly controversial way at the June 16th and 17th FOMC meeting. It was his first meeting as chair, and he made history by completely refusing to submit his own rate forecast for the Fed's famous dot plot.
Wait, I remember seeing the headlines for that, but I don't think people realize how unprecedented it is. The dot plot is part of the summary of economic projections.
Right.
Every quarter, All the Fed governors and regional presidents put a literal dot on a chart showing exactly where they think interest rates will be at the end of the year. Are you saying Warsh just handed in a blank sheet of paper?
Functionally, yes. He abstained from the projection entirely. It is the first time a sit-in Fed chair has skipped the dot plot submission in its entire 14-year history.
That is a massive statement.
It was. He essentially told the market, my guess about where rates will be in December is irrelevant because I don't know what inflation will be in November.
That is wild. But even without his dot, let's peel back the layers of that June meeting. Because the headline that got published in the Wall Street Journal was a unanimous vote to hold rates at 3.50% to 3.75%. Unanimous.
Yep.
It sounds like everyone is holding hands and singing Kumbaya, but the reality behind closed doors was incredibly fractured, wasn't it?
What's fascinating here is the massive disconnect between the current policy action and the future projections. Yes, they all agreed to pause in June. But when you look at the underlying dots submitted by the rest of the committee for the remainder of 2026, it revealed a deeply divided institution.
How divided?
Well, out of the 18 policymakers who submitted projections, 9 of them expect at least one rate hike before the end of the year. 8 of them expect rates to hold steady exactly where they are, and one single member actually expects a rate cut.
So literally half the room is looking at $95 oil and screaming, we need to hike rates, inflation is going to roar back.
Right.
And the other half is looking at the 57,000 jobs report and screaming, if we hike rates, we are going to cause a massive recession.
Precisely. The committee is split right down the middle, which means the decision next week is going to come down to whoever can make the most compelling argument in that room based on the absolute latest data.
So what does this all mean for you listening right now? I think the core takeaway from this Warsh era is that the training wheels are off.
Oh, absolutely.
You can no longer rely on a Fed chair stepping up to a podium and spoon-feeding you a 3-month roadmap. You have to watch the underlying mechanisms yourself, the job reports, the oil prices, the inflation data, because the Fed is reacting to them in real time.
Which brings us perfectly to the market's reaction. Because when the central bank refuses to give you the answers, the market is forced to aggressively place its own bets based on probabilities.
Let's dive into those bets, actually. We are going to map out the 3 distinct scenarios for the July 28-29 meeting next week. The bulls, the bears, and the bell. What is the market actually pricing in as of today, July 24th?
Well, if we look at the CME FedWatch tool, which is an incredibly useful metric that calculates the implied probability of Fed moves based on where traders are putting their money in the 30-day federal funds futures market.
Very reliable indicator.
Exactly. The consensus is leaning toward a pause. The market is pricing in roughly a 60% to 62% probability of a rate hold next week, but that leaves a very substantial 38% to 40% probability of a hawkish rate hike.
Here's where it gets really interesting, though. Look at the velocity of how that probability shifted.
It was incredibly fast.
If you rewind the tape just a few weeks to early July, right before that Middle East ceasefire collapsed, a rate hike was priced at just 12%.
It was basically an afterthought.
Right. Wall Street thought a rate hike was dead and buried. But the minute those shipping lanes were attacked on July 8th and oil spiked back over $95, the hawkish bets absolutely exploded.
Because the institutional money instantly recognized the mechanical transmission of that oil shock. They know that higher diesel costs take about 3 weeks to show up in consumer goods pricing.
They did the math.
They did the math, and they know Kevin Warsh's tolerance for an inflation rebound is practically zero.
Okay, let's break down the actual scenarios. Let's start with scenario A, the pause or the hold. This is our base case. The Fed keeps the federal funds rate exactly where it is, at 3.50% to 3.75%. Why does this happen mechanically?
If the FOMC votes to hold, it will be because the faction focused on the cooling labor market wins the debate.
So they point to the 57,000 jobs.
Right. They will point to that June report and argue that the economy is already decelerating. They will also point out a crucial piece of data. Despite the oil spike, the June headline inflation data actually cooled slightly to 3.5% year over year, down from May's 4.2%.
Okay, so inflation is technically still trending down.
Exactly. They will argue that the lagging effects of their previous rate hikes are still working their way through the system.
Right, and I was reading a note from Morgan Stanley Research that brought up a really fascinating point about the bond market. They argue that the Fed doesn't necessarily need to raise the federal funds rate next week because the bond market has already done the dirty work for them.
Yes, that is a phenomenal mechanical point.
Can you explain how that works? How does the bond market hike rates if the Fed doesn't?
Well, the federal funds rate is just an overnight lending rate for banks. It's very short term. But the economy actually runs on long-term rates.
Like the 10-year Treasury yield.
Exactly, which dictates 30-year mortgage rates and corporate bond yields. In recent weeks, as the market panicked over oil and inflation, investors demanded higher yields to hold long-term Treasury bonds. So the yield on the 10-year Treasury spiked.
So even though the Fed didn't touch their official rate, the actual cost for a normal person to get a mortgage or a business to get a loan went up anyway.
Precisely. This is what we call a tightening of broader financial conditions. Morgan Stanley's argument is that this organic tightening in the open market has essentially done the equivalent economic damage of 2 or 3 traditional Fed rate hikes.
Wow.
Therefore, the Fed can afford to hold rates steady next week and let the bond market continue to do the heavy lifting of cooling down the economy.
Okay, that makes a lot of sense. Let's look at scenario B, the rate hike. This is the bear case for markets. A 25 basis point increase pushing the target range up to 3.75% to 4.00%. Why on earth would Kevin Warsh hike rates into an economy that only created 57,000 jobs? Wouldn't that risk crashing the entire system?
It would absolutely risk a recession. But if they hike, it means they are trapped by the ghost of the 1970s.
Oh, the stagflation decade.
Yeah. In the 1970s, the Fed saw the economy slowing down due to oil embargoes, so they cut rates to help the consumer. But that just allowed inflation to spiral completely out of control, leading to a decade of misery.
So they are terrified of a repeat.
Yes. If the Fed hikes next week, it means they are looking at Brent crude above $95. They are looking at futures markets, like the Street Stats data, showing implied rates rising to 3.9% by October, and they are terrified of repeating the 1970s mistake.
So a hike is essentially a panic move over inflation expectations. It is Cleveland Fed President Hammack, who is already on the record warning that inflation is becoming too broad-based, convincing the room that the oil shock is a bigger existential threat to the United States than a cooling labor market.
Correct. A hike is the ultimate hawkish flex. It would be Kevin Warsh signaling that he will prioritize price stability above all else, even if it means sacrificing short-term economic growth and corporate profits.
All right, what about scenario C, the rate cut, the ultimate bull case? Is a cut even statistically on the table for next week?
What's fascinating here is that while a rate cut in July is effectively a zero probability event, the narrative of a rate cut later in the year is still deeply embedded in several major economic models.
Wait, really?
Yeah. For instance, S&P Global's baseline forecast still stubbornly pencils in 125 basis point rate cut late in 2026, followed by a massive 75 basis points of cuts in 2027.
I'm confused. How can S&P Global justify modeling a rate cut when we just spent 20 minutes talking about $95 oil and 4% headline inflation?
Because their models are rigidly mathematical and they're making a massive assumption. They assume the geopolitical supply disruption is strictly temporary.
Oh, so they just expect the war to resolve.
Basically, yes.
Mm-hmm.
Their model dictates that as 2026 drags on, the sheer weight of these restrictive 3.50% interest rates will relentlessly degrade the labor market. They believe that by the fourth quarter, job creation will actually go negative.
Yeah.
As economic output slows far below its potential, they model that the Fed will be forced to pivot and cut rates to prevent a catastrophic recession, assuming the oil shock naturally fades.
It's a huge gamble on the Middle East cooling down. But for next week, we are definitively looking at a tense hold with a very real lurking threat of a hawkish surprise hike.
I'd agree with that assessment.
So let's pivot to the practical application of all this. How do these scenarios actually hit your wallet, your 401k, and your investments? Let's walk through the major asset classes, starting with equities, the stock market.
Let's do it.
Despite all this chaos, the S&P 500 is hovering near all-time highs. It's trading right around 770 to 7460 as of this morning. How does a hold impact the stock market?
A hold essentially maintains the current, albeit fragile, equilibrium. The market will remain choppy, but the overall index will continue to be supported by a bizarre barbell effect.
A barbell effect.
Yes. On one side of the barbell, you have the massive AI boom driving the valuations of mega-cap technology stocks to the moon.
Yeah.
On the other side of the barbell, you have the energy sector printing massive free cash flow due to $95 oil. A hold allows that strange dynamic to persist without interrupting the flow of capital.
But what if we get the bear case? What if Warsh shocks the market with a 25 basis point hike next Wednesday?
We would likely see a violent, immediate correction in equities. And to understand why, you have to understand the mechanics of how stocks are valued. Analysts use something called a discount rate to determine what a company is worth today based on the profits it hopes to make in the future.
Okay, break that down for me like I'm 5. Why does the Fed's interest rate change what a tech company is worth?
Think about it this way. Let's say a high-growth tech company promises to make $100 in profit for you 10 years from now.
Okay.
If the Fed's interest rates are at 0, you can't make any money leaving your cash in a bank account. So you are very willing to buy that tech stock and wait 10 years for that $100. The stock is highly valued.
Makes sense.
But if the Fed raises rates to 4%, suddenly you can buy a risk-free government bond and easily double your money in a decade without taking any stock market risk.
So the math changes. Why would I take a huge risk on a tech stock if the government is guaranteeing me a massive safe return?
Exactly. As interest rates rise, the present value of those future tech profits plummets. This is why a surprise rate hike disproportionately crushes the valuations of growth and technology stocks, which currently make up a massive, concentrated portion of the S&P 500.
And higher rates instantly increase borrowing costs, right?
Yeah, squeezing the profit margins of any company that relies on debt.
That makes perfect sense. So if the stock market takes a hit from these higher discount rates, where does all that panicked capital go? It usually floods into fixed income, so bonds and treasuries. Let's look at that market.
That's a huge area to watch right now.
Yeah, the 10-year treasury yield is currently sitting elevated, right around 4.69% to 4.71%. What is happening in the bond market right now?
The bond market is currently experiencing a phenomenon known as a bearish steepening of the yield curve.
Okay, I have to stop you. Bearish steepening sounds like absolute financial jargon bingo. Walk me through the mechanics of what that actually means for someone looking to buy a bond.
It does sound like jargon, but the mechanism is crucial. A yield curve simply tracks the interest rates of short-term bonds versus long-term bonds. Normally, if the Fed cuts rates to stimulate a dying economy, short-term bond yields plummet faster than long-term yields.
Okay.
The curve gets steeper. That is called a bull steepener, and it usually signals a stock market rally is coming.
But you said we are in a bear steepener.
Right. A bear steepener happens when long-term interest rates rise aggressively, faster than short-term rates. It means the bond market is waking up to a terrifying realization.
That inflation is going to be sticky for years.
Exactly. And the Fed is going to keep rates highly restrictive for a very long time. Investors are demanding much higher yields to lock their money up for 10 or 20 years because they fear inflation will eat away their returns.
So how do you trade that? If I'm an investor looking at a bear steepener, what is the play?
Well, Morgan Stanley is advising clients to embrace the yield. They recommend relying on high-quality fixed-income assets and building what are called bond ladders.
How does a bond ladder work?
Instead of buying one 10-year bond, you buy a 1-year, a 3-year, a 5-year, and a 10-year bond. As each one matures, you reinvest the cash. This allows you to lock in these currently elevated 4.7% yields while protecting yourself from the volatility if Kevin Warsh decides to hike or cut unexpectedly.
That's a smart strategy. Let's move down the risk spectrum entirely and talk about cryptocurrency, specifically Bitcoin.
Always a popular topic.
Yeah, it is trading near a 2-week high, right around $65,500. A big part of this momentum is just massive institutional adoption. I mean, we've seen something like $600 million in ETF inflows over the last 5 days.
Massive numbers.
But here's the question I always get, and it drives people crazy. Bitcoin's entire value proposition is that it is a decentralized hard asset completely outside the fiat banking system. So why does Bitcoin care what Kevin Warsh does on a Wednesday in Washington?
It is the ultimate irony of the crypto market. Yes, Bitcoin operates on a decentralized cryptographic network. But the fiat currency used to purchase that Bitcoin, the US dollar, is entirely centralized and controlled by the Federal Reserve. Fed rates dictate the fundamental strength of the US dollar and the overall global cost of capital.
Because if rates are low, money is cheap to borrow, liquidity floods the global financial system, and investors have a massive appetite for risk.
Exactly.
They throw money at tech stocks, venture capital, and Bitcoin.
Cheap fiat liquidity is the rocket fuel for Bitcoin. But when the Fed keeps rates high, the US dollar strengthens. Capital becomes very expensive to borrow. Investors pull their money out of risky assets and seek the safety of high-yield government bonds.
So mechanically, a hold next week is relatively neutral for Bitcoin.
Yeah, a hold is neutral. But a dovish surprise, say, Warsh accidentally hints that cuts might come in late 2026, could blast Bitcoin much higher.
Potentially testing new all-time highs.
Absolutely, because it signals that the era of cheap liquidity is returning.
But if we get the hawkish surprise...
If Warsh hikes rates, or uses very aggressive language about keeping rates high indefinitely, you could see a sharp, rapid liquidation event in Bitcoin. As global fiat liquidity dries up, Bitcoin could easily drop back down into the low $50,000 as institutional investors flee to safety.
Speaking of ultimate safety, let's look at precious metals. Gold is currently trading near $4,075 an ounce.
Which is still historically huge.
Now, that is down significantly from its insane January all-time high of $5,589, but historically, over $4,000 is still incredibly elevated. Silver is hovering near $58 to $60.
Right.
I'm looking at this and thinking the mechanics are broken. High interest rates are historically supposed to crush gold, right?
See, that's the textbook theory.
Because gold is just a shiny rock. It doesn't pay a dividend. It doesn't pay a yield. If you can get a guaranteed 5% return on a risk-free treasury bond, why would you hold gold? It creates a massive opportunity cost.
You just perfectly described the traditional textbook mechanical relationship between real interest rates and gold. Under normal circumstances, 4.7% treasury yields would crush gold prices. However, the current 2026 market is completely overriding that traditional mechanic for two massive structural reasons.
I imagine the first one is just raw geopolitical terror.
Yes. The war in the Middle East, the collapse of the shipping lanes, the constant threat of escalation, it creates a massive safe haven floor for metals. But the second reason is much more mechanical and permanent. We are witnessing unprecedented structural buying by global central banks.
Right. I was looking at the World Gold Council data. Global central banks bought an astonishing 244 tons of physical gold in the first quarter of this year alone.
Huge numbers.
Led heavily by the People's Bank of China and the National Bank of Poland. Why are they hoarding physical gold when they could be earning 5% on U.S. treasuries?
Because they are aggressively diversifying their sovereign reserves away from the U.S. dollar. They're looking at the weaponization of the dollar in global sanctions. They're looking at the U.S. debt load. And they are choosing to hold a neutral, non-fiat reserve asset.
So it's a structural shift.
That immense structural demand from central banks is acting as a massive pillar, keeping gold prices elevated over $4,000 despite high interest rates.
So if we were to see a dovish signal from the Fed next week, indicating that rates might finally fall, which would cause the U.S. dollar to weaken, it would effectively remove the only headwind holding gold back.
It would.
That could be incredibly supportive for a massive rally in both gold and silver.
Exactly. The upside potential there is very real.
We've spent a lot of time on the trading floor in global macroeconomics, but I want to bring this back home. I want to move away from Wall Street and ask how this high-rate policy environment is actually impacting Main Street, commercial banking, and everyday borrowing.
This is a vital pivot.
Because this is where the macroeconomic data actually hits the listener's wallet.
And this is where the environment is becoming highly stressed, often outside the view of the daily stock market ticker. The bank prime loan rate, which is the baseline interest rate that commercial banks use to price loans to their very best, most creditworthy corporate customers, is currently sitting at a punishing 6.75%.
So what does higher for longer actually mean mechanically for a local business? Put this into perspective for, say, a mid-sized regional plumbing and HVAC company that needs to buy a new fleet of trucks, or a local developer holding commercial real estate.
It means they're facing a slow-motion crisis of refinancing. Let's walk through the mechanics. Imagine a medium-sized logistics company that took out a $10 million commercial loan 5 years ago to expand their warehouses.
Okay.
Back then, interest rates were near zero. They built their entire business model, their payroll expectations, and their profit margins around paying a very tiny interest expense on that debt.
Right. Money was practically free.
But commercial debt isn't like a 30-year fixed-home mortgage. Commercial debt usually matures every 3 to 5 years in balloon payments. So now, in 2026, that $10 million note matures.
The bill comes due.
The logistics company has to pay the bank back. But they don't have $10 million in cash sitting in a vault, so they have to refinance the loan.
But now they're walking into a bank where the prime rate is 6.75%. The cost of that money just exploded.
Exactly. Suddenly, their monthly interest expense doubles or triples overnight. For many Main Street companies operating on thin margins, that new interest payment instantly wipes out their entire annual profit margin.
It's devastating.
They become Xylee companies. To survive, they're forced to lay off workers, slash expansion plans, raise prices on consumers, or in severe cases, declare bankruptcy.
And we are seeing this exact scenario play out on a massive scale, too. Look at First Brands Group earlier this year. They produce massive amounts of auto parts. Windshield wipers, spark plugs.
Huge company.
They recently entered Chapter 11 bankruptcy, burdened with over $11 billion in liabilities. It is the ultimate cautionary tale of what happens when a highly leveraged business model collides with a structurally high-rate environment. The math simply stops working.
And the terrifying part for Main Street is that the headline federal funds rate is only half the story. There's a secondary mechanism squeezing the banking sector that operates entirely in the shadows.
So what does this all mean when we talk about quantitative tightening? Because the Fed has this balance sheet task force operating in the background, and I think 99% of people have no idea what it is or how it silently drains money out of the economy.
If we connect this to the bigger picture, quantitative tightening, or QT, is the Fed's stealth tightening tool. To understand it, you have to rewind to the pandemic. During the crisis, the Fed initiated quantitative easing.
Right, QE.
They digitally printed trillions of dollars and used it to buy treasury bonds and mortgage-backed securities from banks. This flooded the banking system with raw cash and artificially forced long-term interest rates down to zero.
But now they are reversing that exact process. They are essentially putting the toothpaste back in the tube.
Precisely. Through quantitative tightening, the Fed is holding on to those bonds. When a bond matures, the government pays the Fed the principal amount. Normally, the Fed would take that money and buy a new bond. But now they're just taking that cash and deleting it.
Deleting it, like literally.
Yes, they're literally erasing the money off their balance sheet.
So how much money have they deleted so far?
Since they began this process in June 2022, the Fed has quietly shrunk its balance sheet by a staggering $2.2 trillion.
Wow.
Mechanically, by not reinvesting that money, the Fed has removed a massive trillion-dollar source of guaranteed demand from the bond market.
And basic supply and demand dictates that if there is less demand for bonds, the price of bonds falls. And when bond prices fall, the yields, the interest rates, go up.
Exactly. This $2.2 trillion runoff is artificially keeping long-term interest rates higher than they would normally be. It acts as a stealth rate hike.
That's wild.
It drains liquidity out of the commercial banking system, making banks much more hesitant to lend money to that local plumbing company we talked about earlier, all without Kevin Warsh ever having to hold a press conference to announce a hike in the federal funds rate.
It is like tightening a vice grip on the economy in a dark room.
That's exactly what it feels like.
So to summarize the massive swirling crosscurrents we are looking at going into next week's July 28th and 29th FOMC meeting, we have a Federal Reserve that is utterly terrified of oil-driven inflation caused by the war in the Middle East, and they are draining trillions in liquidity to fight it.
Right.
At the exact same time, we have an economy showing severe cracks in employment, with only 57,000 jobs added in June, yet supported by a massive AI technology boom.
Yep, the barbell effect.
And right in the middle of this hurricane, we have a market nervously pricing in a tense 60% probability of a hold on interest rates, but knowing full well that Kevin Warsh could drop a hawkish rate hike at any moment and blow up the stock market.
That is an excellent, comprehensive summary of the monetary and macroeconomic landscape. But to fully grasp the sheer tension in the United States economy right now, we have to introduce one final, massive contradiction that we have not even discussed yet.
And it might be the most important factor of all.
I think it is.
The fiscal side of the house, the government itself.
This raises an important question. How can the Federal Reserve successfully cool down the economy to fight inflation with restrictive interest rates when the federal government in Washington, D.C. is simultaneously pumping the economy completely full of cash?
Yes, the fiscal-monetary dissonance. We have to talk about the OBBBA, the One Big Beautiful Bill Act.
Yes.
This was recently enacted by the President and Congress, and it is a massive front-loaded fiscal and tax stimulus package. Under the mechanics of the OBBBA, everyday U.S. taxpayers are seeing an average $2,300 tax cut directly hitting their paychecks in 2026.
Mechanically, this creates the ultimate macroeconomic tug-of-war. Think about the opposing forces here. The Federal Reserve, representing monetary policy, has its foot slammed on the brakes.
They are trying to stop the car.
Right. They are keeping the prime rate at 6.75%. They are destroying $2.2 trillion via quantitative tightening, and they're desperately trying to crush consumer demand to bring prices down.
But the federal government, representing fiscal policy through the OBBBA, has its foot slammed on the gas pedal. They are injecting billions of dollars directly into consumers' pockets.
And people spend it.
When people get a $2,300 tax cut, they spend it. They buy goods, they take vacations, they renovate their homes. That inherently boosts demand and structurally drives inflation higher.
It is absolute madness. The central bank is actively trying to drain the bathtub to prevent a flood, but the government keeps walking in and pouring giant buckets of water right back in.
Can monetary policy possibly win a tug of war against that kind of massive fiscal stimulus? I mean, if the government keeps handing out money to voters, won't Kevin Warsh be forced to keep interest rates punishingly high forever just to offset that injection of cash?
That is the defining existential economic question of 2026. Historically speaking, when monetary policy and fiscal policy are operating in direct, diametric opposition to each other like this, it creates immense volatility.
Because nobody knows who will win.
Right, the bond market begins to panic because they don't know who is going to win. And usually, the result of this kind of dissonance is higher structural inflation lasting for a much longer period of time, accompanied by much higher baseline interest rates.
Because the Fed has to hike harder just to neutralize the government spending. It is a vicious cycle.
It absolutely is.
And on that note, that is the provocative thought we're going to leave you to ponder this week. When you watch the headlines hit the tape next Wednesday afternoon, when you see what Kevin Warsh and the FOMC decide to do with that 3.50% to 3.75% interest rate, ask yourself a deeper question.
Are they just fighting the 95 oil shock from the Middle East?
Are they just fighting the 57,000 jobs report? Or are they quietly fighting their own government's fiscal policy? Thank you for taking this deep dive with us into the incredible complexities of the 2026 economic landscape.
It's been great.
We know it is a dense, tangled web of competing data, but understanding the underlying mechanics, the why and the how, is the absolute only way to truly protect and grow your portfolio in this kind of volatile environment. Stay curious, keep a close eye on the underlying data, and we will see you on the other side of the bell next week.